Ángel López. You can call me Miguel, which is this my abbreviated name. And I am an ambassador of PhotonHub Europe. So I am participating in this presentation as a PhotonHub Europe ambassador. Probably you know, but PhotonHub is a pioneering program which is designed to equip entrepreneurs like yourselves with that have a photonics innovation to equip them with the knowledge and skills needed to maximize their business potential during the crucial early stages of their first developments. This accelerator, PhotonHub, is a one-stop shop that offers investment readiness support in a wide range of crucial topics, including accessing equity and cascade funding, approaching venture capitalists, and avoiding common pitfalls in fundraising. Also, last but not least, we also help create direct connections for all our participants to explore exciting funding opportunities. And precisely, this is today's topic. As you can see, what we're going to cover today is extremely related to fundraising. Actually, as you see in the cover, it's called raising finance. Raising finance is a complex topic that I try to make as easy and approachable as possible. And since these webinars are short, they're going to be around 30 minutes of content, and the rest is open to you for any questions that you like. I divided it into two lectures. So today we're going to cover the funding basis 1. Okay, so let's start. And first of all, let me introduce myself. As you know, my name is Miguel, and I have several areas of expertise. One of them is fundraising and venture capital. Well, about my professional experience, I've worked in business development and also in funding in 12 organizations in 4 countries. I am a certified business mentor for the Foundation Madrid Más in Spain. And I've been working as a business coach and business mentor in business development, fundraising, and strategy and entrepreneurial strategy for several clients and a lot of European accelerators, such as EIC Accelerator, for PwC, for iBusiness School, and also for private clients, always in innovation and technology. Maybe the most important thing for you to know is that I've also invested in startups. I've been an angel investor in 7 startups. So many of the things that I'm going to explain to you in this presentation and the following one in several days are based not only in theory. Obviously, I studied theory. I learned, I read a lot of books on the topic. I also collaborated with venture capitalists. I don't say it here in this presentation, but I used to be the COO, the Chief Operational Officers of IBAN, the European Business Angel Network, which is based in Brussels. And yeah, I know the theory, I got the connections, but also put skin in the game. I invested in startups, and also most importantly, I also lost money investing in startups. What does it mean? It means that some of the knowledge that I'm going to share with you is not only based on theory, but also on the painful situation that I made my own mistakes and I realized what worked and what doesn't. Okay, so I would try to, again, make this complex topic as approachable as possible, but also bear in mind that I invested a lot of money to learn these things, and I also lost money doing things poorly. Hopefully, since you are all entrepreneurs, you will help your future investors not only to succeed, to make your company succeed, but also to deliver a great return to your investment. Let's start with some key aspects, and one of them is not said here. In case you have any questions, since we are just a limited amount of people, there is no problem for you to interrupt me. Okay, I have 40 slides ahead. If you don't want to interrupt me, there is no problem. You can write your questions in the chat, and my colleagues at PhotonHub will be compiling them, and we can answer them at the end of the presentation. But if there is something which is really, is on the top of your head or is really worrying you at the moment, there is no problem if you interrupt the session and you ask me the question directly. Just raise your hand. You have your digital hands there. So raise your hand and feel free to ask me any questions, because topics are related to fundraising, but they are different topics, each one of the other from the other. So maybe you want to make the specific question at the specific time. Having said that, before we start the presentation, some key aspects. First, this is a general outlook, okay? Second, as I told you, this is a complex topic, so the limitations is that I'm going to explain things, say, in an 80% theoretical point of view and 20% practical. But still, you need to master the basics, which is the goal of this presentation. Also, I'm going to cover only the most critical aspects, which is great because I will be, cutting down to the chase. I will be telling you, focus on this. And as entrepreneurs, you need to know where your focus should be at. Third point, I'm going to talk about your point of view, the point of view of the entrepreneur, not the investor, because the investor has not a different game, has a complementary game. But I assume that my audience are entrepreneurs. Then I will be only focusing on fundraising for companies like yours, companies working with innovation and with a high growth potential. And finally, my focus will be on venture capital financing. This means that you will give the shares of part of the ownerships of your company in return for the capital you want to raise. And finally, this is one of the key lessons of today's presentation. Investors expect that you deliver a high profitability to their investment, no less than 4 times and an average between 12 and 8. Actually, I've met business angels in the past who told me, Miguel, if the startup doesn't offer me a business case in which they can multiply my money at least 12 times, I wouldn't bother talking with them. So let's put some numbers. Imagine that you raise, say, 100,000 euros. So if you want to give your investor a multiple of 12, you need to return to the investor 1.2 million. And I didn't make any mistake. You need to have the ability to convert 100,000 euros into 1.2 million euros. So that's the game. And I'm telling you from the start, that's what venture capitalists expect from you. Let's continue. Which is my goal? As I told you, I want you to avoid beginner mistakes, to focus on the basics, to increase the probability that you will achieve financing with this information, and also not only achieving the money, but also achieving smart money. Smart money means that if you partner with investors, investors should provide you, especially at this early stage of your company, investors should provide you not only capital, but a smart capital, brains, not only euros, but also their intelligence, their connection, etc. Because you need as much help as you can gather. The more smart money, the more probability of success. Okay, this is the intro. And these are the contents that I want to cover in the two lectures. In today's lecture, we are going to focus on 4 specific topics. First, do you really need finance? Second, is your company investable? Third, how much you need to ask? And fourth, the investment options. With this, we will cover our 30 minutes. In the next lecture, we're going to talk about where to find investors, the investment rounds, because usually you won't be raising money once, you will be raising money several times, the valuation of the company, aka your pricing, the investment process, and the main conclusions for you to take home. Okay, so let's focus on today's content. And let's start with something that maybe seems philosophical, but it is not at all. Do you really need to raise money? Why I'm asking this question? Because first, raising finance is only an option. You are not obliged to raise finance by default. Maybe you can create your company, you can develop your company, maybe you can grow your company without any finance and still become a leader. That's a possibility. Just to give you one example, yes, it's not from the photonic sector, it's from the classified sector. But let me show you this company from Spain, Mil Anuncios. Was a company of classified ads. So why I'm putting it as an example? Because several years ago, this company, which was managed by a very small team of 2 people, of 2 programmers, were able to create a company that was sold as you can see in this piece of news, for 50 million euros in cash from one multinational media company called Schibsted from Sweden. And they created so much value without any funding round. So that's a possibility. This is absolutely possible. In some sectors more than in other sectors. Obviously, this is an example from software, but I think you understand the point. The point is that raising finance is not obligatory in a startup land. It's an option. So there should be some alternatives, and definitely they are. First thing that we can do is do everything ourselves, meaning that, hey, we don't need to raise money. We can manage with our own financing. Another alternative is that, as I was telling you minutes ago, if you want to partner with an investor, okay, but you can partner with other kind of partners. For instance, you can partner with vendors, you can partner with other competitors, you can partner with other entrepreneurs. It's likely that you need some support, some help, but you don't need to raise finance in order to get that support. You need complementary people. Also, you can set up alliances. Partnership means that you are in the same business together, but for less, for things which are not so, let's put it, intricate, things that are not so strongly connected, maybe isolated alliances to deliver specific things in your business development would be more than enough. You don't need to partner. You don't need to have a privileged relationship with somebody who is complementing you. Okay, so in those cases, raising finance is not necessary. When I mean raising finance, remember, as I was telling you in the intro, I am talking about venture capital. I will describe it later. Therefore, seek finance only if your business plan requires it, and you need to explain it carefully. If it's impossible for you to develop your business only using your own resources, and this is something that can be discussed, because maybe you want to be too ambitious at the beginning. Maybe your venture needs to be limited in scope so that you can start getting traction without raising finance. Maybe that's an advisable an advisable way of acting for most of you. Also, don't seek finance because it's in vogue, or because Facebook raised finance, or because other companies raised finance. I mean, again, it's not obligatorily. It's not a sign of glamour. Also, never raise finance because you are afraid to risk. So, okay, instead of risking my money, let's risk other people's money. No, it doesn't work like that. Also, don't raise money because investors offer you security. Not at all. You are still on the steering wheel. The company is still yours. So if you're insecure, raising money and having investors won't add an extra layer of security on you. On the contrary, you will need to have an extra layer of management. And finally, don't raise money just in case, because I mean, maybe you're beginning to realize that raising venture capital is very expensive. Let me tell you in advance that it's the most expensive money you can get for your startup. Okay, so let's do it if it's really needed, not because, okay, it's nice to have an extra bit of money. Why not seeking finance? Okay, so if you don't seek finance, you will be obliged to optimize your own resources, which is always very important. Okay, so don't delegate on the money you raise what you need to be done on your own management. Also, you will retain all of your independence. The company will be fully yours, because when you're raising capital, you are renouncing to several shares of your company, to a percentage of the ownership of your company. And you will be diluted. Diluted is a term that we use in venture capital to mean that your benefits, your property share will be less. Therefore, if you keep the full control of the company, all the profit will be yours, which is a very nice thing to have. Also, we won't lose focus, because raising capital is strenuous, it's exhausting. It takes at least 6 months. Several times I met entrepreneurs telling me, well, I will be bankrupt in 3 months. I need to raise money now. No, you're already late. If you want to do this professionally, if you want to do this at the right pace, usually investors will request you not to rush things. At least you will need 6 months. So imagine during these 6 months, you need to raise finance and at the same time manage your company. It's a lot of pressure for the executive team. And why seeking finance? Well, because maybe if you don't do that, you will lose opportunities. Because if you get investment money, you will have more synergies, more resources, maybe more agreements, contacts, etc. Maybe competition has already raised venture capital, so you will be at a disadvantage vis-a-vis the competition. And also, if your plan is not to manage your company forever, but to sell it in some point in the future, you need to have a valuation. Again, a price for your company. So how to find out how much my company is worth? Well, putting your company in the market, which means that it needs to have a valuation, and in the valuation, somebody needs to buy, to purchase whatever you're putting on sale, the full company or just some percentage of the company. Okay, so seeking finance is also a way to put a pricing on your venture. Okay, so bottom line, really think about if you really need finance or not, because if not, why bother? Okay, let's say that, yeah, I want to raise finance. Okay, then you need to do a self-analysis. Is your company investable? Because venture capital only wagers on investable ideas. I told you already, and let me tell it again officially. Private venture capital investors seek profitability. Therefore, they won't wire on non-investable companies or ideas or PowerPoints or self-employment. They want to find major profitabilities in relatively short time frames between 4 and 8 years. Therefore, venture capitalists filter projects by ongoing metrics, because metrics, for instance, traction metrics such as revenue, monthly recurrent revenue, pipeline of customers, things like those, are clues to the potential profitability of the investment. So how can we know if our startup is investable? In order to achieve it, in order to do that analysis, I recommend that we use the 3-point system of Professor Rob Johnson from IES Business School in Barcelona. Why am I recommending this system? Because this system is used, at least here in Spain, for a lot of business angels. For example, the most important business angel in my country is Luis Martín Caviedes, and this investor has sold deals to Amazon. Actually, Professor Rob Johnson was a professor of investment to Luis Martín Caviedes. And I had the feeling that this system will be really helpful for you to understand to what degree your company is investable. This is also for you a way to understand how the brain of an investor works. So before you finding out in a meeting, let me tell you first. The 3-point system means that the business has to be first viable. Only if it's viable, then we need to check if the business is feasible. And only if it's feasible, then we can check if the business is investable. This is like a video game. We need to kill a monster in each screen. So let's start with the first screen. Viable. How do we know if our business is viable? 2 items. First, we need to prove that we have a market with sufficient customers, that we are not covering any unsatisfied need. Therefore, we need to provide investors with a thorough analysis on customer segments and the needs of the market and the solutions we want to offer to these markets and the value we provided to this market. Second item, we need to show a competitive advantage of our product or service over competitors or substitutes. Competitors that do exactly the same things that we do, and substitutes are things or alternatives that, albeit mediocrely, but they can substitute us. For example, we are using Zoom to deliver this webinar. As an alternative, we could have used Teams. An alternative to Zoom, a substitute of Zoom could be, for instance, if we exchange it written letters. I can deliver this lecture by sending you letters, but obviously the results will be not as good as using a video conference system. Therefore, our business will be viable only if we prove investors that there is a market that will accept our offer and that we have a competitive advantage that competitors don't have, and that we are able to sustain that competitive advantage in time. It could be that we have a proprietary technology, that we have a customer base amazing, that we have connections with executive directors of customers. It could be whatever. But if we don't have a competitive advantage, we are not viable, because it would happen, as Professor Johnson said, we will be launching a product, and actually we will be showing the path for the next. If we prove this market and this competitive advantage, then we can move to the next screen. Feasible. How can we prove if our company is feasible? Again, 2 items. First, we need to have a complete team with proven capability. What is a complete team? We have a CEO, which is the leader of the company. The leader takes care of what is going on in the company from 1 year on. The CEO doesn't look at the present, he's looking at the future. Then we also have the CTO, the product creator, the magician who creates the technology, the amazing technology. Then we have the business developer with a commercial profile, or the salesperson. We're in business, therefore somebody needs to sell. And finally, we have the operations director, or COO. The COO takes care of all those things that the CEO is not taking care of. The day-to-day work. COOs makes the day-to-day work of the business work like clockwork. For example, takes care of customers being served, of all the machines working, all the salaries paid, etc. So we need to have a complete team, and each member of the team needs to do these roles. Okay, so the ideal team has 4 people covering these 4 roles. Then we're talking about timing. Timing is complicated to explain, and that's the reason why it is so critical in venture capital. You need to tell me that now it's the time for your company to succeed. It's not too early, not too late. It means that you need to do a thorough analysis of your industry. You need to know your competitors even better than they know themselves. Before they react, you know how they are going to react. And you have a plan B, a plan C, or you have everything under control. This is so important that Professor Rob Johnson says, if something makes sense, it would already exist. And if it doesn't exist, there must be an explanation. Okay, so most of you entrepreneurs say, hey, I have a first mover advantage. There is no competition because I am the first. Well, if you are the first, maybe it's because of something. And maybe you are the pioneer. And the pioneers usually have problems to reach the treasure. Maybe they died in the way. So again, explain me why it's great that you're first, not because you say so, but compared to your competitors, you got something that competitors doesn't have, the competitive advantage. So let's imagine that we prove that we have this team that can deliver and that the timing is perfect. Then we prove that our business is feasible. Then and only then we can move to the final screen, investable. How can we prove at this moment to an investor that, hey, my company is investable for you? First, my business model is scalable, not my product, my business model. It means that with arithmetic inputs, especially variable costs, I will get geometric results, especially sales, especially money. That means high growth potential. High growth means in revenue, especially cash. If it's cash, amazing. And why so? Because as I told you at the beginning of the presentation, investors expect that you multiply their money by 4, by 8, by 10, by 12. Usually when investors exit the company, they sell the company. And they sell it in EBITDA multiples. That's a detail that we will talk in the section about valuation. Okay, so EBITDA, probably you know this financial metric, means earnings before interest, taxes, depreciations, and amortizations. Meaning, this is the money created by the company before somebody else is getting money out of the company. For instance, banks, the state, etc. Okay, so we need to produce a lot of money, a lot of cash. And that's the reason why having a scalable business model is essential. If not, you cannot multiply their money by 10, by 12, as venture capitalists request. Finally, your company is investable if there is a clear and foreseeable exit for the investor. The investor is not going to be with you forever. The investor invests in you because they want an ROI, a return of the investment. Therefore, if you claim that your company is for you forever or this is a lifestyle business, no. You need to offer an exit to the investor. And usually, these exits are M&A, mergers and acquisitions, meaning that your company will be eventually merged with somebody else, or somebody else is going to buy your company. And that's how the investor is going to get the return. There are other alternatives, but this is what usually happens, M&As. By the way, in the presentation, you have the sources of this information. Let's continue. Let's go to the next topic. The next topic is how much you need to ask. Okay, so we decided in the first section that, yes, I want to raise finance. The second part is, well, my company is investable because I have a market, I have a competitive advantage, I have a team that delivers. The timing is perfect. My business model scales and will produce a lot of money, and the investor will have a clear exit in 4, 5, 6 years. Okay, so I am able to play the game. And obviously, if you want to raise finance, how much do you want to raise? Okay, so you need to accurately calculate your financial needs. And the financial needs of a startup are not the sum of the investments, nor the sum of the expenses of any year, nor the cumulative losses of the first 10 years. Which is the correct way for you to calculate how much you want to raise? Like this, as you see in the slide. First, make 3 5-year financial projections, albeit incomplete or whatever. You can tell me, hey, Miguel, this is wishful thinking. Still, we need to have a ballpark. So create projections that you can modify in the future. Then in your projections, do not put any cash flow from investment or finance, meaning not only raising capital, but also getting debt, going to the bank. Only in your financials, put cash flows from operations, meaning the capital that will be generated by the business, by your customers. So if it means that customers won't be joining the company in 3 years, so be it. So the first 2 years will be losing money. After having done that, review your cash flows and locate all negative balances. The highest negative balance you can identify is your need for finance. In another way, if we did not arrange financing to cover this negative balance at that specific point in the future, your company will go bankrupt. You will understand it easier if you see this very simple image. So here we see a chart and we see the revenue of a company. As you see, the company starts in the month of January, and in the month of February is losing money. Then it gets some revenue in the month of May. The revenue is going fine. However, there is another expense, and the company is again in the reds by the month of August. And all of a sudden, everything is going fine in October, and in November is again, in October and in November is again profitable. Actually, November is more profitable than ever. So as you can see, in this theoretical example, there is 2 moments in time in which the company is in the red, in February and August. But if you realize the February down is wider than the August down, that's your need for finance. You need to cover your negative cash flow in the month of February and in that specific month of February, because if not, you will be bankrupt. You won't be able to pay your vendors, to pay your salaries, to cover all your expenses. So this is what you need to raise. Again, coming back, make projections. Just put the money you generate with the business, not extra money from investors or from debt. Identify the most negative cash flow you can find, and that's what you need to request to investors. Remember, venture capital is expensive, so just request the money you need at the right moment. Not earlier, not late, because you will be paying extra for that capital. And this is all the amount that you need to ask. So again, you need some detailed calculations, or at least a business hypothesis. Finally, let's cover the fourth section, investment options. Okay, so again, you want to raise finance, your company is investable, you know you want to raise X, 500,000, 100,000, 1 million, 2 million, whatever. So then you go to the market and say, hey, okay, I want to raise this amount of money. Which are my options? Okay, let's start one by one. The first options are called the 3 Fs, founders, friends, and family. Even some people say that there should be a fourth F called fools. This is the first capital that you should ask almost obligatorily, compulsory, because it's first, it's the money you have under your control. For instance, your savings, your unemployment benefits, your mortgages, etc. Then the money you can get from your network of trust. Many investors says that if you are not able to raise money from your friends, from your family, how come that you're approaching me? I am a total stranger to you and you request me money. No, 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 no. Prove me that at least your trusted people trust you and give you money, albeit little, but your closest people should give you money. One very important detail, and this is what distinguishes professionals from amateurs. In this round, in the 3 Fs, don't give out equity to your loved ones. What you should raise are loans, not shares, okay? So my point is that instead of giving your mother 10% of your company, give them a loan with an interest of, say, 3, 4, 5%. Usually your loved ones, the only thing they want to do is to support you. They don't want to get an interest. So maybe you can get this money with 0% interest, okay? So do it like that, loans. And also you need to keep as much shares in your company as needed, because since there are going to be several rounds, you want to keep equity in your company to deliver it to real professional investors, not to your loved ones. Among the different loan options, I recommend you use the convertible loan option. What does it mean, a convertible loan? A convertible loan is a loan in which if you reach certain milestone, you give the right, but not the, the investors have the right, but they are not obliged to convert their loans into equity. Okay, so let's imagine that the milestone is, I want to reach a 1 million euro valuation. When you reach that valuation, maybe you can give your mother the option to convert their shares into equity, or just to get the interests and get out. That's what I recommend you use this, because only among your loved ones that are willing to continue the journey will be willing to convert their loans into shares. If they just wanted to support you, it's the time for them to get the return of their investment, maybe 1, 2, 3% interest, and off they go, and you keep the entire control of the company. This is the first option, and this is compulsory for you. If you're not able to raise money from your loved ones, it's difficult for you to prove that you're worth. Then we have the public funding. Public funding, we're in Europe, so we are in the land of public funding. Actually, you can find public funding internationally, nationally, and regionally. For instance, internationally, we're in PhotonHub, we're an international accelerator. And there are also other programs such as EIC Accelerator, which is one of the most important ones in the European Union. National public funding, it depends on the country. So for example, here you have examples from Italy, from Germany, from France. So probably there are loans, or maybe there is a venture capital public companies in each country. So it depends on each country. You need to do your own research. And the same with your region. Public funding is interesting. However, the time in which this public funding was just grants is long gone. Most of them are loans. Therefore, you need to return your loan. Second point is fluctuating finance. You can't depend on it a priori. It means that some years there will be money, and maybe some years there won't be as much money as the previous year. Okay? So we cannot trust that the money will be there when we need it. The latest trend is doing co-investment with venture capital. For example, I know the case of Spain's ENISA, which is the public national company for innovation, and they deliver participative loans. I will talk about participative loans later, but they only give the loans if you get venture capitalists to co-invest with you on a 50% basis, at least. It's more common that ENISA gives 40% and they request you to raise 60% of the total round with VCs. And also bureaucracy. It's a lot of bureaucracy. So my recommendation is don't waste your time. If you're really serious for that, subcontract a firm. Usually there are consultancy firms that have done this in the past and know the nuances, have the connections, know how to write the applications, etc. So obviously you can do it yourself. But again, if you need to raise money from venture capitalists and also manage your company, develop your technology, and also work on the grant, sincerely, it's too much. So if you can afford it, delegate it. This goes for public funding. Next option, and we get into venture capital, business angels. Business angels are an essential and critical actor of the ecosystem. There are individuals, such as me, that risk their own money. Frequently, there are people who are being successful in business and they want to support other entrepreneurs or give back to the society their knowledge, but making a money in the meantime. They don't usually manage the company. They support the entrepreneur, but they are not in the day-to-day operations. They're very selective, only look for deals with a good return on the investment. In that sense, they behave exactly the same as venture capital firms, and only 10% of them are visible, according to my former employee, Ivan. 90% of business angels are private. How to reach them? Obviously, we need to date the visible angels, and those angels know invisible angels. So we need to get introduced by other angels. It's also very common that we don't have we won't find loan riders in the business angel world. They are more and more professional, and they usually co-invest with other angels or with other venture capital firms. There are also business angel networks in which they co-invest together. There are lots of them in Europe and Latin America, and they are created by a lot of organizations. Some are private, some others are created by chambers of commerce, university, technology centers, etc. And in the slide, you have several ways to find them. In databases such as PitchBook, Crunchbase. There are also companies which does equity crowdfunding, and equity crowdfunding, I will talk about equity crowdfunding later, usually co-invest with angels. National associations of business angel clubs are also frequent in many countries, such as Spain, or you have EBAN, where I was working in the European Union. And also you can find them in LinkedIn, in blogs, for example. I identified this lady from here, from Madrid, and a guy, as you see, she identifies herself as a business angel. Or another business angel is François Derbe. Even though his name is French, he lives here in Spain. I know François personally, and he's been one of the most active business angels in Spain, and he has this blog. His blog's in Spanish, but as you can see, he says investor in fintech startups. So also in the blog sphere, you can find angels. But again, use these sources to find visible angels, and then via the visible angels, reach the invisible angels. Venture capital. Well, venture capital is the next stage in the menu. There are companies which manage large capital amounts from third parties. Therefore, venture capital firms doesn't manage their own money, the money of their partners, but the money of their customers. Okay, so we can even give money to venture capital firms and they will manage it for us. Okay, and they invest in several stages of the development of a startup. Some of them will be interested in extremely early stage, and some of them will be interested only in Series B, Series C, meaning in a more developed, in a more advanced development of the company. Their investment is also temporary, is between 4 and 10 years. Their goal, obviously, is to get an ROI. They will sell for sure their shares in the company. And each one has their own criteria, their own investment interest and levels. So it's very difficult to make a summary of all venture capital firms. Each one of them has their own style. So my suggestion is that you approach the venture capital firms close to where you physically are and start analyzing all of them. As an example, in Madrid, I know Sherpa Capital, which manage middle-sized companies, as you can see in their website. Therefore, if you are in a small startup, it won't be your target. But also, if you're in a small startup, maybe you can go to Caviedes, to the business angel, who also is owner of a small venture capital firm, because he's specialized in investing in really early stage companies. So again, Caviedes and Sherpa, two venture capital funds, but two different styles. One is more early stage and the other is more advanced. And this is quite generic because VCs have also different alternatives. I was talking to you about firms. Firms means that a company raises money and manages the money on behalf of their investors. But also you can find venture capital funds. Funds are estates administered by the management company, and they usually come in vintages, like wine, meaning that we set up a fund in 23, we want to raise money between 2023 and 24, and when we raised all the money, the fund is closed. Maybe in 25, we will raise another fund with money from our customers, but it means that the investment window is closed, okay? That's a difference with the venture capital firms. They're always open. Funds can be open and closed, and unless the venture capital fund creates a new fund, there won't be an open opportunity for them to invest in other companies. And also we have family offices. Family offices are private estates that are managed like VC funds. Most of them are private, so it's also great if you can network with rich people in your area, but some of them, for instance, the one of José Manuel Entre Canales, are public. This one is based in Madrid, and this is the public estate of the business owner of Acciona, which is one of the most important multinationals in infrastructure in the world. So they behave like venture capital funds, but their interests are associated to the one of the family. Another part of the menu is crowdfunding. Maybe you have heard about crowdfunding. Crowdfunding is using platforms on the internet to raise venture capital, but in small amounts from a big crowd of investors. Small amounts could range between 500 euros up to 50K, but usually the average amount is 1,000, 2,000, etc. There are two kinds of crowdfunding that could be interesting for you. One is reward and the other one is equity. In reward crowdfunding, you are pre-selling items, and the most known platform is called Kickstarter. However, you will be more interested in equity crowdfunding platforms because they behave like venture capital firms. But again, instead of approaching professional investors, they usually approach retail investors. The most important companies in Europe are Crowdcube and Seeders in the UK, also Companisto in Germany. But again, the goal here is not to raise, for instance, 100,000 euros from one single investor. You need to raise 1,000 euros from 100 investors in order to reach to raise the same amount of money. That's an alternative. Actually, crowdfunding could be an alternative also if you combine it with other sources such as public money or with venture capital firms or also with business angels. So these sources are not exclusive, they don't exclude each other. You can combine them if necessary. Here we see an example of a Kickstarter campaign. As you see, in this case, there is an item in which they were pledging, they wanted to raise 8,000 pounds, and at the end, and at the moment I took this screenshot, they raised 58,000 pounds, so well above their funding goal. And this one is coming from Cedars. This company was creating drones, and the target was 336,000 pounds, and they were able to raise, at the moment I took this screenshot, 276,000 pounds. So that's a possibility. And if you see 276,000 pounds from 112 investors. Okay, so yes, this is great, raising the money, but also bear in mind that you will need to manage 112 investors. And that's a crowd. Participative loans, as I was telling you, these are usually public funding coming from agencies such as this one, ENISA in Spain. But the good thing about participative loans is that they behave like venture capital if your company eventually fails, but if your company is successful, they will behave like loans, meaning that you will only have to pay an interest, 8%, 10%, instead of multiplying the money by 10, by 12, etc. Usually, participative loans from public institutions also have more advantages. The payback time is really long, 7-9 years. Interest is variable but close to the market, for instance, Euribor. In your balance sheet, this money looks like capital, not like debt. It means that you can get extra debt for a bank if it's necessary. And also the interests are usually tax deductible. So it's also great for tax purposes. And the most important thing, as I told you, if you get this money and your company fails, you are not obliged to give the money back to the state. The state accepts that this is a venture capital investment. But again, if your company is successful, hopefully it will be, you need to give the money back. I told you about ENISA, but also you can, if you're in Germany, you can approach the key FW ERP startup loans. And my suggestion is that you research your network, what is available in your country. Okay, we are finishing. The last option that maybe you can have is international investment, but this is rare, especially if you are in an early stage. But again, you can approach websites such as AngelList, accelerators in the United States, because they used to invest internationally, or international events, such as, for instance, South Summit, or 4 years from now, which are held here in Spain. 4 years from now is held in the Mobile World Congress. So for example, this is a screenshot of AngelList, and this is a screenshot of South Summit, even held here in Madrid. Well, this is all I wanted to share with you. So we have 5 minutes to go. So again, thanks for your attention, and I'm open to any question you may have. Okay, do you have any questions? I opened the chat. I see no questions here. Everything clear, or you were lost? Okay, apparently everything was perfect, or everybody's silent. Okay, then we have Hao here with his hand raised. Yes, Hao?
Hi, I have a question about since you mentioned how much to ask, and the question is, I mean, if you know how much you ask and how much equity you want to give, and basically the question is how to value a startup. I mean, since startup is early stage and maybe don't have a product or sales yet, then how to value the company?
Okay, this is a topic that I want to cover in the next presentation, because as you see here, I will talk about valuation. But still,
Okay.
let me tell you. Anyway, let me answer to you. My recommendation is that you use the EBITDA multiples method. Why so? Because usually for startups, many people discusses between discounted cash flow or EBITDA multiples. The issue with discounted cash flow is that I need to accept that the revenue that you claim in your business plan that you're going to get is going to be a reality. But as you said, if you are a really early startup, you don't know how much are you going to sell in 5 years. Therefore, doing a discounted cash flow or something which will be wishful thinking is not really useful. However, if we use EBITDA multiples, which is the theory behind that? I will explain it in detail the next day, but the theory is this.
Yeah, thank you.
Which is the end of the investment. The investor will exit. Why the investor will exit? Because somebody else will buy the company at a valuation. Okay, so the idea is, let's see deals similar to mine in the past. Let's see the valuation of those companies at that moment in time, and more or less I can extrapolate what happened in the past, what could happen with me in the future. So let's imagine that your company is doing something related to laser, and in 2023, a laser company, I don't know, in Germany, was sold to an American multinational. Okay? Since it was sold, there was a price. In those kind of deals, those pricings are based on EBITDA multiples. Why so? Because the purchasing company is anticipating the EBITDA that this company is going to generate in the future. And usually there are I know for sure, there are companies that every year measure the EBITDA multiples that are used in M&A deals all over the world and throughout many industries. For instance, BDO, the consulting company. Okay, so what you need to do is analyze a similar deal, check out the valuation, check out the EBITDA multiple they used. Maybe you can get to BDO and get one of their reports. And then more or less you can extrapolate, okay, if this company was sold at 8 times EBITDA, if my company in 2028 is going to be generating an EBITDA of 10 million, therefore the valuation of my company at that time will be 10 multiplied by 8, 80 million. So that would be your thesis. And if you realize it's not, pure guessing, is that, hey, I claim that my company is going to be similar to that company that was sold to 8 times EBITDA in 2023. So that's your business case. Another thing is if your investor accepts or does not expect that theory. But what is real is that this is market pricing. Okay, it's not pure guessing. A real company was sold at a price. And that's the reason why I'm recommending it to you, because if something was sold at a pricing in the market, it's market price. Discounted cash flow is, air over air over air. It's pure theory, pure business, pure wishful thinking. Did you get the idea, or is it too complicated?
Yes, yeah, I got the idea. Yeah, thank you so much.
Okay, perfect. Thanks, Hao. Any more questions? Well, apparently, Maria, everybody's happy, or at least they are not saying anything.
Perfect. Then we couldn't be happier. Thank you very much, Miguel Ángel, for the webinar. Much appreciated. So just an information to all the participants. We'll share Miguel's webinar, of course, through PhotonHub community. If you want to find out more, I don't know whether you know that, but I'll say it, Miguel Ángel, Miguel Ángel is also a mentor in our investment readiness coaching and investment matchmaking program in PhotonHub. And currently we have the submissions open till the 4th of October, so till Wednesday, 5 p.m. So you're more than welcome to apply. My colleague has already put the link to the submission system in the chat, but we'll be publishing that also in PhotonHub community, and also you can find it through PhotonHub LinkedIn. So we encourage everyone interested in the topic to apply to find out more. So thank you, Miguel Ángel. Thank you.